Hey everyone, in today's video, I'm going to be talking about 10 stocks that are absolutely crushing the market here. Now, generally, these 10 stocks are either crushing the market because they had really strong earnings reports, which we'll touch on in this video, or they're very interest rate sensitive. And while they've been going down a lot over the last handful of months with interest rates ticking up, bond yields in the US have actually been trending down, which has had a really big positive impact on the outlook for some equities. So we're going to touch on both of these types of stocks throughout the video. Starting off with the first stock here, it is Shopify. So Shopify is a Canadian tech company, payments company. Many of you have definitely heard of them or interacted with their products before. It is up 22% here today after beating their earnings and outlook expectations. Looking at this one a bit longer term before jumping into their report, they really have gotten hit over the last month with the broader tech sector. So it was down about 10%, made up for that and more here today. Year to date, this one's up 70%. In the last 5 years, up 300%. But it really depends when you got into this one. It was trading for around $40 on a share adjusted basis before the pandemic and went all the way up to over $200 before crashing down to 30. So this one's been on an absolutely wild ride, but at the end of the day, this is a great growth company. Let's take a look at their results here. They increased their revenues in the third quarter by 25% up to $1.7 billion, currently have a 10% market share in the US e-commerce business, and their market cap's at about $100 billion here. So still a pretty big company in terms of valuation for a company only doing a couple $1 billion of revenue a year. But when we look at their growth rate, we've seen them grow at a very high clip here. Monthly revenues from $38 million back in 2018 and very steady, nice growth all the way up to over $140 million here. So it's really interesting, and this is true with lots of growth stocks. While we continue to see through the pandemic and coming out of the pandemic growth, even if it was a bit more slight since lots got pulled forward here, we continue to see strong growth, yet the share price is a fraction of what it was, down under $100 versus the $215 there. So obviously, growth rate has a factor in that. Also, interest rates, which we also talked about in terms of the bond yields in the U.S. going down a bit, that has a beneficial aspect to these growth companies with more profits out in the future. So those two things have really helped the company fly in the last 2 days here. In addition to that, they had a really good outlook. So their outlook on the business was to deliver 25% growth in Q4 as well. And I think lots of analysts expected their revenue growth, just as the company's gotten larger, to start decelerating at a larger rate, both because of the law of large numbers, also just because of discretionary spending maybe ticking down a bit. And as we look at lots of the companies that Shopify partners with, if I just go to the slide here, lots of companies here that are in discretionary spaces, Ashley Home Stores, Spanx, Gymshark. Lots of these products aren't necessarily needed on a day-to-day basis or staples necessarily. You can also look here, which is interesting, the brands that they added in the third quarter. So some of these are pretty big, well-known brands that can just help them accelerate their revenue growth going forward. So it was both the fact that they posted a really strong earnings, really strong revenue number, but I think it was mostly the fact that they had a very strong outlook that investors weren't really anticipating, and that's why shares went up over 20% today. Second stock here, we'll go through this one a bit quicker, is Brookfield Infrastructure Partners. So Brookfield Infrastructure Partners, this is the US ticker, but they trade on all kinds of tickers. I'll go to the Canadian one briefly here. The Brook ticker BIPC. This one also trades in partner shares as well as just a normal equity stock. Different valuations just because very different tax implications. So be sure to watch out on that if you're considering buying Brookfield Infrastructure. But on this one here, you can see in the last 5 days specifically, up 15% on Brookfield Infrastructure Corp. The partner fund looks like it's up a couple more percent. But this one is getting killed if I look long term. Last 6 months has been down over 25%. I'd say this is one that has benefited both because of interest rate outlook maybe ticking down a bit, as they have a lot of debt. And that's very similar with lots of infrastructure, utility companies, as well as real estate companies. So that debt servicing cost has really hampered the outlook on the stock. But with that being said, they actually posted really strong earnings of about 74 cents funds from operation a share on their partnership fund. Let me get that one up here quickly. Here it is. Oh, I'm having a hard time finding it. This is the US version. So the Canadian stock trades about $33, $34, I believe. And that was annualized to close to $3 a share in funds from operation. At $33, $34 on the Canadian ticker, it's trading right around 12 times current year earnings. So pretty cheap valuation for this company. Longer term, they've typically traded in a mid-teens to high teens multiple. So investors like the fact that they posted earnings growth, and that's earnings growth despite the fact that they're dealing with higher interest rates. So that pushed up the stock a couple days ago. As we look at the 5-day trend here, went from, on the US stock, $22 up to $24, about a 10% jump. And then from then to today, we're up to $27 just based off of the interest rate news, as well as just continued strength from those numbers. The next stock here that's been moving up huge is Allied Properties. Allied Properties actually hasn't really reported earnings over the last few days, but the stock's gone from $16 to $15 a couple weeks ago, all the way up to over $17. So about a 10% jump even after the earnings were digested. Looking at those earnings, you can see here they actually did funds from operation on an adjusted basis of 55 cents. So on an annual basis, and so far year to date, they're on pace to do between $2 and $2.20 of funds from operations. Looking at the stock, that puts them right around 7.5 to 8 times funds from operations on the year. So this is one that lots of investors have been really worried just about the amount of debt that they have on, as well as if their occupancy rates will continue to take a hit given they are an office REIT. So you can see here leased area sitting at about 88%. I'd say that's not great. It's always great to be above 90, but it's definitely not Armageddon or dire at this stage. So we'll keep a close eye on how this number moves sequentially in the quarters to come. But overall, for the amount of profit and earnings this company's spitting out, it's trading at a really cheap multiple, supporting their 10.7% dividend. I actually listened to their earnings call from a couple weeks ago. Someone asked a question about the dividend, and the response from, I believe it was the CFO, was it's not going to be a question whether we keep or cut the dividend. It's going to be a question about how much we consider increasing the dividend next year. So they were really bullish on holding this 10-11% yield and actually growing it. So I think just the news that we saw here on yields closing or yields falling really help benefit stocks like REITs just because of their exposure to that treasury yield rate and just yield rates in general as they reservice their debt and they have to pay off the debt that they currently have on their books, which is just a fundamental part of the business model of running a REIT, leveraging up to amplify returns in terms of the spreads they're getting between cap rates and interest rates. So it really does impact that value equation for these equities. The next stock here that's really flown up 4% today. If I take a 5-day look at it, or a 1-month look at it rather, up 8% here in the last month, is Canadian Utilities. This is one of the longest lasting Canadian dividend growth companies, has increased their dividend for about 55 straight years. You're seeing here getting a starting yield of 5.8%. Now, they only increase their dividend a couple percent a year because it's a very mature company. They're not growing at the same level as they were before, and they have a really high starting yield, but still really impressive for them to be able to be increasing their dividend over that period of time. Taking a look at their valuation here, so they were trading closer to $28 a few weeks ago, currently at $31. So at $31 a share, expected to do about $2.30 next year. So they're trading at about a 14 times earnings. I think that's probably, in my opinion, fair for the environment we're in now, the type of cash flows they spit out, and the types of moats and industries that they play in. I think a mid-teens earnings multiple is fair, especially with their track record with the dividend growth. So I think it may have been trading a bit cheap, closer to 12 before this run-up. So I think this one here is justified. Going into the last Canadian stock before getting into some big US stocks that have been moving hugely here today and over the last week is Northwest Healthcare. So this company did not report earnings yet. They will report earnings next week, but they went up over 7% just because of bond yields ticking down, or the outlook for bond yields ticking down in the US. This one has had a horrendous last year, as lots of you who've watched my channel before has probably seen, as I unfortunately own some of this stock, from $11 down to $4.50. So even after today, still down about 65%. Getting a decent dividend yield here. I know they recently cut it, but I think it was cut to 36 cents. So currently paying around 8.5%, even at the cut dividend. They've historically had funds from operations around 80 cents. I know with debt servicing costs, some pressure has been going on that. But they do have a midterm plan, if they're able to execute and action it, to get closer to $1 of funds from operations a year, which if they actually execute that in the midterm, the stock is trading extremely cheap on that future looking multiple. So this is one that just went up big today based off interest rates kind of settling down a bit, potentially declining. And it just goes to show when you own some of these stocks that have just been hammered for no reason. Well, this isn't a no reason one, but primarily because of interest rate exposure, that can really turn on a dime when interest rates start going the other way. This company specifically has been a combination of a lot of things, but you can see the interest rate portion of it has been notable just because of how much it jumped on one day of sentiment and potentially turning the other way in terms of the rates. Going over into the US stock, Starbucks here, up over 10% on the day for Starbucks. This is a $100 billion company moving double digits. And it's one thing to see a company like Shopify, a big tech company, growth company, moving double digits. But this was startling to see a big retail food company up double digits on earnings. So let's take a look at what happened here. Before that, let's take a look at their market cap, about $115 billion, paying out a 2% dividend yield. Looking into how this stock went up. So a couple of the sound bites out of their earnings. First, consumers buying into more expensive drinks. There's a lot of rhetoric in the notion that consumers may be not buying expensive drinks as much, more pressure on discretionary spending. That was not the case with Starbucks. The second thing here was 3% increase in traffic. So that was fantastic to see with lots of pricing going on in the market, especially for these types of products. The fear and concern have been, will we lose consumers? Will less customers come? Will customers come less frequently? They actually had a really nice uptake of plus 3% in traffic to their stores, despite higher pricing, despite pushing more premium products. So that's a phenomenal result. And I think that's probably combined with just the traction they're getting on more expensive drinks, how this stock's rallied and the story behind the stock's really been reaffirmed to investors, driving the stock up 10% today. So that was great to see. The other thing here, lots of investors, especially for these big US companies, really want to ensure the US business is strong. That's kind of the cash cow that they use to pay most of their dividends, expand operations internationally. And the fact that the US locations had very strong outperformance versus lots of expectations, I think was just kind of the cherry on top. So just looking at this company a bit, wanted to look at a few things. First thing was looking back a couple months, they recently increased their quarterly dividend. So they increased their quarterly dividend, let's see how much here, from 53 to 57 cents. So a pretty nice increase, about 7-8% there. And over the last 13 years, they've had a 20% CAGR on their dividend growth. So looking at the company here, it hasn't been doing fantastic in the last 2 or 3 years. Longer term, it's been on a nice run. But even if I go back here to during the early days of the pandemic, or even right before the pandemic, January 2020, stock's trading at $93. We're 3.5 years later at $100. So I'd say with the dividend in, it's been at best an average performing stock. Despite that, the company continues to increase the dividend pretty nicely, as you saw in that last chart. And let's just take a look here at some of their guidance in terms of how their income statement came in and their same-store sales. So we can just take a quick look here. They're growing at 8% on same-store sales, over 11% last year. So that's a really strong comp that they're competing within the base and delivered a high single digits number. That's fantastic. Operating margins up huge. I'm sure investors like that one as well. And that obviously responded into high operating income. So it looks like an absolute home run of a quarter here. I just want to look at their income statement a bit, just to look at where they're having strength. You can see here, licensed stores growing 19%, company-owned stores up 11%. So that's interesting to see licensed stores, even though it's a smaller part of the equation, up almost 20%, significantly higher than company operated. Going through here, you see their costs have actually been under control. Operating costs 5%, product cost 8%. So while inflation is still around in the economy, they've been able to increase pricing and trade customers up significantly at a faster pace as their expenses have been growing. So total expenses only grew 6%, which just makes sense how they beefed up margins to that extent with that kind of backdrop on the revenue and expense line. Looking at average shares outstanding, they went from 1.15 to 1.14, only bought back about 3 million shares, it looks like, versus a year ago. So that wasn't a big deal, but they did increase the dividend there. So overall, a lot of strength, especially on the expense controls. That's really impressive to see for the company as well. Looking longer term at their share buybacks, they've done a pretty good job. I know in the last couple of years, it seems like they've been dealing with kind of that union fight and other things that have made it optically disadvantageous to buy back large quantities of shares for investors. But they've still done a decent job over the medium term here. They used to be closer to 1.2 billion, 1.22 billion in 2019. Now they're at 1.15 billion. So they've bought back 3-4% of the company over the last 3-4 years. So at least they're giving some back to investors through share buybacks, in addition to that 2.3% dividend yield. In terms of the valuation, so they had an absolute rock star quarter. Looking at current year, $3.30. So they're trading over 30 times this year's earnings. They're going to grow a lot, though, in terms of investors' eyes. So closer to 385 next year. That's still like a 27 times earnings multiple. So you're definitely paying up for this one, even when compared to like where McDonald's and some of the other quick service restaurant stocks have gone. This still seems to be a pretty big premium. So yes, they've done a great job. Growing store traffic's really impressive in this environment, passing on pricing, boosting margins, increasing the dividend, still doing share buybacks. But they have, I think, with this 10% increase in stock price, lots of that value to investors seems to have been realized here today, at least in my opinion. Next stock on the list is S&P Global. So I do actually own this stock. It was great to see it jump 7% today. This stock owns a lot of different types of assets. So looking into the types of assets they own an indices business where they own the S&P 500, Dow Jones, any index that is run off of those and more of their assets. They actually get a couple basis fees out of the management fee. So that's a very recurring income, a recurring revenue business that has very high margins. In addition to that, they own one of the two biggest rating agencies on debt and other securities in the world, between them and Moody's. And no matter what's happening in the economy, I always say, if the economy's good, the economy's bad, something like the pandemic happens, every company's always raising debt, raising securities. So it's a great moat business that will continue to have demand. And it's really hard to compete with the credibility that Moody's and S&P's built up over the last few decades. So it's a business that I'm really bullish on, and I think definitely has a very high floor, let's put it, in terms of how far down that business can go over the medium term. And they also own a big data business where they sell important data to hedge funds, other types of businesses to make investment decisions as well. So lots of businesses they have with very high moats, strong growth trends on them. So it does trade at a pretty high multiple here. Looking at the stock currently on the year, it's up 12%, so not too bad. Last 5 years, it's done phenomenal. It's doubled up in the last 5 years. Looking at some of their comments on their earnings here. So they had extremely high demand for the data and analytics side of the business. So that's lots of the data that they provide to hedge funds, other types of businesses. and they actually adjusted their earnings forecasted up to $12.50 to $12.60 a share from $12.30 to $12.50. So a slight increase, but definitely nice to see. At $12.50 a share on the year, the stock's trading right around 30 times earnings here. So 30 times current year earnings. But when we look at next year, they're expected to do about 12, 13, 14% higher than that. So we're trading at about 26 and a half times 2024 earnings, which for the moat that they have, for the types of industries they're in, I think that despite paying a premium valuation, this is an industry that I'd rather pay a premium valuation on versus Starbucks, in my opinion. Starbucks is a great business, just a lot more competition, a lot less room for growth, in my opinion, and a lot lower margin business than something like S&P Global and where they play. The next stock that we're going to be talking about today is Affirm. So Affirm has been up around 20% throughout the day. Looks like it went down 1% here, but currently at 19%. And they did not report earnings, but they did announce a partnership with Amazon, which is huge. When we just look at the scale of this partnership, Affirm's a $6 billion company. Amazon, on the other side of the coin, is a $1.4 trillion company. So over 200 times the size. And I know they're not going to be a partner on their entire business, but they are unveiling buy now, pay later services for small business owners who use the Amazon site, which is really exciting for a small company like Affirm to get that kind of business. So it seems like they're going to be providing business loans or offer business loans to Amazon sellers so they can help manage inventory and not be cash starved as they're waiting to get paid by Amazon and things like that. So this Amazon's probably thinking of it as an enabler for their selling community and a huge benefit for their selling community to have access to these kinds of loans and pay later options to really help them accelerate their Amazon stores and their Amazon business. So it's a win-win. Affirm can get in there, make a bit of a cut, hopefully, for them. But when we look at Affirm, company's still trading at around $20 a share. This is one that went absolutely wild during the pandemic. Scared to look at the 5-year here. But yeah, it went all the way up to $160, then went down probably to single digits, under $10, and now we're here at 20 after the deal was announced. But they are still extremely unprofitable, over $2.50 loss this year, more than $2 next year. So between this year and next year, they're going to lose $5 a share, which equates to about $1.2, $1.3 billion on a $6 billion market cap. At some point, I don't even know if more volume, and I haven't looked at their balance sheet, but I don't even know if more volume is good for the company if they don't have structural economics that make sense. Maybe they just need scale, in which case a deal like this will be fantastic. But for me, a company losing over 10% of their market cap a year in net losses is extremely risky, especially in a high rate environment where it's lots of opportunity costs for that money that's being bled out of the business, and just increases how much they have to dilute shareholders or raise more money at these high rates. So it's not a business I'm interested in, but was shocked to see the jump today. So it was interesting to see the news behind that. Going into the next stock here, it is Roku. Roku reported earnings up 30%. Huge earnings for Roku here. Let's just take a look at kind of their last year to date. Year to date, they've almost doubled up here. So I think they probably got hit pretty hard going into the year. And then they're coming out of it really strongly, almost 100% up year to date. In terms of what their report was, so they had a big net loss on earnings, but it seems like they had some benefits on revenue that surprised to the upside. So $912 million in revenue, which was 20% growth, net loss of $2.33 a share. Okay, so still planning on losing a lot of money. Looking at this one, $78 a share. So they're going to lose 3% of their market cap this quarter in earnings. And just if I annualize that, assuming all else equal across quarters, they're losing $10, $11, $12 or 10, 11, 12% of their market cap a year in net losses. This is not a company that just showed up on the block a year ago. Roku, I feel like, has been around for a long time. So this is one that it's concerning to see this level of loss in this environment after this amount of time. And once again, yeah, I'm sure if they get enough scale, continue to grow, they'll begin to be profitable. But just the fact that they haven't been able to do it over this amount of time and have structural economics that they can pour more fuel on the fire for just concerns me. So while I'm sure there were some great sound bites in the report, maybe investors like the 20% revenue growth, they probably over the last year, as we look at the stock doubling year to date, are cheering the kind of drive of streaming with Netflix's strong report a few weeks ago. But this is not exactly where I'd be interested in playing streaming if I had an option, just because of the underlying profitability of the company here today. Maybe they'll be able to fix it. Maybe they'll be able to price, drive synergies, drive scale. But today they're just bleeding way too much for a relatively developed company for my liking. And the last stock out of the 10 stocks that are crushing the market this week is Palantir. So Palantir is up 20% on the day after their earnings. Looking at it longer term, up 140% in the last 6 months. So similar to some of these stocks that kind of IPO during the pandemic, they've gone on a wild ride. Let's give it a 5-year chart here. They skyrocketed up to $30, $40 a share before going down closer to $5. And here they are at 18. So, hopefully for long-term investors who have been kind of holding throughout all of this, they'll eventually get a good payout. Or for investors who bought at the bottom, congrats, because they've done really well. Looking at just the earnings here briefly, their revenue increased 17%, so $558 million. If I assume they're going to do $2.2 billion on the year, and they're at a $39 billion market cap. Wow! So people are paying almost 20 times, call it, 18, 19 times revenue. So obviously a lot of exciting stuff with AI and whatnot, and the contracts they have are very recurring in nature. So it's definitely lots of benefits that investors see and are pricing in. But wow, what a multiple that they're getting here at these levels, around $20 a share. Earnings per share, great to see they're not bleeding like some of the stocks that we just went through, but still relatively mute. They probably have the opportunity to be investing more in their business. They're trying to be a bit more conservative. They don't want to swing to huge losses, so they're managing their expenses maybe a bit more reasonably and 50-50 than some of the companies that we just saw. But they still have great growth ahead of them, likely. And in my opinion, these are ones that I just have a really hard time with. For different style of investors who are looking for 10x growth and much more risk in their portfolio, maybe these are the types of stocks to chase after. But I just can't even fathom buying a company for 20 times revenue in an environment where I can get 5 or 6% yield on cash. So this one, in my opinion, is just at a valuation that I wouldn't even consider, no matter what kind of business or what kind of growth outlook they have over the extremely long term. The fact that even next year, if they're growing at 15-20% this year, even if they comp that next year or grow slightly higher, they're still going to be trading at 15 times revenue, which is just way too much of an opportunity cost to be giving up when there's so many other high-yielding assets and other strong businesses in the market as well. So one that I'm staying away from, but congrats to the investors here today, up over 20%. And geez, on this one, over 100% on the year. So those are 10 stocks that have just been absolutely crushing the market here. Hope you like me reviewing these quickly. Let me know in the comments if you're buying or you own any of these stocks. And if you haven't yet, be sure to just give this video a big thumbs up. It really does help with the YouTube algorithm. And consider subscribing to the channel as well. I'll see you guys in the next one.